Modern audit engagements often involve complex transactions, specialized industries, and sophisticated information systems that require expertise beyond the auditor's own technical competence. Consequently, international standards on auditing recognize that external auditors may rely on the work of experts, internal auditors, component auditors, and service organizations when obtaining sufficient appropriate audit evidence. However, the responsibility for the audit opinion always remains with the external auditor and cannot be delegated to another party. Auditors must therefore evaluate the competence, objectivity, and quality of the work performed by others before placing reliance upon it. In addition, auditors must adapt their audit procedures to the unique characteristics of not-for-profit organizations, whose objectives, funding structures, and governance arrangements differ significantly from those of commercial entities. External auditors rely on the work of others primarily to improve audit efficiency, obtain specialist knowledge, and address complex areas requiring technical expertise. Modern financial reporting frequently involves matters such as property valuations, actuarial calculations, environmental liabilities, pension obligations, financial instrument valuation, information technology systems, and legal disputes that require specialist knowledge unavailable within the audit team. Similarly, multinational organizations may require coordination with component auditors located in different jurisdictions, while highly automated businesses may require information technology specialists to evaluate system controls and cybersecurity risks. Reliance on appropriately qualified experts enables auditors to obtain more reliable evidence while maintaining audit quality and completing engagements efficiently within reporting deadlines. The external auditor may place reliance on the work of an auditor's expert or a management's expert, subject to careful evaluation. Before relying upon expert evidence, the auditor should assess the expert's professional competence, qualifications, experience, reputation, objectivity, and independence. The auditor should also understand the scope of the expert's work, evaluate the appropriateness of assumptions and methodologies applied, and determine whether conclusions are consistent with other audit evidence obtained. For example, property valuations prepared by independent chartered surveyors, actuarial valuations of pension liabilities, or specialist impairment calculations may provide persuasive evidence where the expert possesses appropriate competence and objectivity. Nevertheless, the auditor retains ultimate responsibility for evaluating whether the expert's findings provide sufficient appropriate evidence supporting the financial statements. External auditors may also consider relying on the work performed by the internal audit function, particularly when evaluating internal controls or performing certain substantive procedures. ISA 610 using the work of internal auditors permits such reliance where the internal audit function demonstrates sufficient objectivity, technical competence, systematic methodology, and quality control procedures. The external auditor should assess the organizational status of internal audit, reporting relationships, professional qualifications, and the quality of documentation supporting audit conclusions. Where reliance is appropriate, external auditors may reduce duplication of work by considering internal audit findings relating to control testing, compliance reviews, operational audits, and risk management evaluations. However, significant judgments, areas involving high audit risk, and matters affecting the audit opinion remain the sole responsibility of the external auditor and require direct evaluation. Many organizations outsource accounting, payroll, information technology, or transaction processing functions to service organizations, creating additional audit considerations under ISA 402 audit considerations relating to an entity using a service organization. Because financial information processed by service providers may affect the entity's financial statements, auditors must understand the nature of outsourced services and evaluate the associated control environment. Examples include payroll processing companies, cloud-based accounting systems, investment custodians, and data processing centers. Where significant financial information is processed externally, weaknesses within the service organization's controls may increase the risk of material misstatement for the user entity. When auditing entities using service organizations, auditors may obtain evidence through several approaches. They may review service auditor reports, such as Type 1 or Type 2 assurance reports, inspect contracts governing outsourced activities, evaluate user controls implemented by the client, communicate directly with service providers, or perform additional substantive procedures where reliance on service controls is limited. The auditor should determine whether controls at both the service organization and user entity operate effectively together. If sufficient evidence cannot be obtained regarding outsourced processes, the auditor may need to expand substantive testing or modify the audit approach to reduce audit risk to an acceptable level. Although auditors may rely on the work of others, reference to that work in the independent auditor's report is generally inappropriate. International standards on auditing require that the audit opinion remains solely the responsibility of the signing auditor, and reference to experts or internal auditors is normally omitted because such reference may be misunderstood as dividing responsibility for the audit opinion. An exception arises where law or regulation requires reference to another auditor or where a modified opinion specifically explains the effect of limitations relating to another party's work. In normal circumstances, therefore, the auditor assumes full responsibility for the opinion expressed regardless of the extent to which the work of others contributed to obtaining audit evidence. Audit engagements involving not-for-profit organizations, NPOs, require adaptation of traditional audit techniques because such entities pursue social or charitable objectives rather than profit maximization. Examples include charities, educational institutions, hospitals, religious organizations, foundations, and government-funded agencies. Their primary sources of income often include donations, grants, subscriptions, fundraising activities, and public funding rather than commercial sales. Consequently, auditors must understand the specific regulatory framework, governance structure, funding restrictions, and accountability requirements applicable to the organization. Audit procedures for not-for-profit organizations focus on areas of unique audit risk. Auditors verify the completeness and accuracy of donation income, inspect grant agreements to ensure funds are used for authorized purposes, evaluate restricted fund accounting, examine fundraising receipts, confirm government grants, and review compliance with donor-imposed conditions. Analytical procedures may compare fundraising costs with donations received or evaluate expenditure against approved budgets and program objectives. Auditors also assess governance arrangements, trustee oversight, volunteer controls, and stewardship over charitable assets. Where cash donations are significant, particular attention is given to segregation of duties, cash handling procedures, and reconciliation controls due to increased fraud risk. By appropriately evaluating the work of experts, internal auditors, service organizations, and specialized service providers, while adapting audit procedures to the unique characteristics of not-for-profit organizations, external auditors obtain sufficient appropriate evidence to support an independent opinion. Effective coordination with the work of others enhances audit efficiency without diminishing auditor responsibility, while specialized audit approaches ensure that financial reporting remains transparent, accountable, and reliable across both commercial and non-commercial sectors.